What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be taking a look at Pepsi stock because the stock has been falling for a while now. As you can see, this year the stock is down a little bit over 10%, and it was trading at about $170 or so for a while, and now we are down to 150. So today I bought 15 shares because the risk to reward profile is just really attractive. We have a dividend of 3.5%, and the big news here is that for one, RFK wants to take out sugary drinks out of shopping carts of food stamp recipients. So that has kind of hurt Coke, Pepsi, Dr. Pepper, etc. But the good thing about Pepsi is that I found this article. This is about a week old now, but this is still a big deal. Even for a company as big as Pepsi, this is a big deal because it looks like Subway has switched their products to now Pepsi instead of Coke. And I mean, Subway is one of the biggest chains in the entire world. They have over 20,000 locations out there. So this is a 10-year deal to use Pepsi products, which is going to be huge. That should create an enormous amount of revenue and profits for Pepsi. So that's what I like. But if we get into the details here, we can see that Pepsi is a $200 billion company roughly. Revenue is usually pretty strong. These last couple years have been extra strong, growing at about 7% per year. Net income, fairly consistent, you could say. Last couple years we're averaging there. I mean, there was a big drop off going into 2019, but since then it's been growing at a couple percent per year. And the cash to debt is not good, unfortunately. 10 billion in cash is a lot, but 37 billion in debt is a lot more. The other thing I like here is the dividend has consistently grown pretty much every single year. And we're looking at a payout ratio of 78%, dividend yield of 3.5%. Shares outstanding has consistently come down just a little bit. And then return on capital is now 17%, and profit margin is 9%. So nothing crazy, but still pretty strong. I mean, we're looking just for a safe, consistent business model. That is Pepsi. And although this RFK piece is sort of could be somewhat bad news, possibly in the next couple of years, just maybe. I mean, these companies are fighting back too. See, lawmakers have tried unsuccessfully for decades to restrict soda, desserts, and candy from food assistance programs. So I don't think this is going to be easy for RFK to do. It's possible, but doesn't, I don't know. It's just that's just a maybe. There's just a chance that happens. This, though, is a big deal. This getting a 10-year deal with Subway to switch out Coke products for Pepsi, that's a big deal. So I'm comfortable buying 15 shares today at this price. And if we want to look at what analysts have them doing, we can see here that we got what? We got EPS 61 next year. So pretty much you're paying 18 times earnings, and then for next year you're paying 17 times earnings, which is super cheap. And then we go back to the historical data here to see forward PE has been, and this is the cheapest it's been in at least 2 years now, between 17 and 21, right? So I'll happily buy it at 17 times forward earnings. That's pretty cheap. So that is my analysis for Pepsi. I'm not expecting to double my money, but I am expecting to get roughly 15% in the next year or so, I would say. But it's got a strong dividend there. I really am going to be happy with 3.5% dividend if these interest rates continue to fall. And next year we're probably going to see rates go below 4%. At that point, a 3.5% dividend is going to look pretty strong, especially if they raise that dividend. And as the stock price keeps falling, that yield is going to get higher. And so, I mean, the stock hasn't been this low in a couple of years. It's Pepsi we're talking about. This isn't Palantir or Tesla. So it just looks like a safe bet to me. That is my analysis for Pepsi. Let me know what you guys think down below, and I will see you in the next video.